Hello everyone and welcome to another real estate video. This is Javier Vidana, the real estate YouTube guy here in Phoenix, Arizona, helping you accomplish your home goals. So when I have people, asking for an idea of their monthly payment, or maybe they're online shopping, getting ideas, they always get like a really great sense of what their payment's going to be because they're like, what, this house is this payment? That's fantastic. And then once they actually talk to a realtor and a lender, we end up being the bad guys because we have to tell them, hold up, you forgot to include this, this, and this. And the silent killer, if you will, of your monthly payment is usually the mortgage insurance. That's right. You're thinking your payment's going to be nice and low, and then you realize it's actually $100 to $300 more than you thought it was. So what I decided to do is call a really great friend of mine, the great friend of the channel. All the people who are fans of mine know her already well. The queen of lenders, the queen of everything that is to do with anything mortgage. And if you don't follow her, you guys need to be following her. So the link's below. Before you even watch this video, click her channel, subscribe to her. So I'd like to introduce formally Miss Lizy Hoeffer. Come on in, Lizzy. I wanted to bring you in to talk about mortgage insurance. Okay, so mortgage insurance. What is it and why is it needed?
Mortgage insurance definitely gets a really, really bad name when it comes to like payments and then just real estate professionals, clients. But essentially it has like a very, very long history in lending and with the government. It actually started out after the Great Depression as a way to encourage banks to continue to loan out money because they were hardest hit when people default, right? When bad economic times, banks typically lose lots of money. And so mortgage insurance was created to then encourage them to start loaning out again.
So essentially it's a way for for banks to protect themselves from people who take mortgages out in case they ever default to their mortgage. They get most of their mony back or all of it? How does it work?
The bank would get a large percentage of it back.
Perfect. We're going to talk about specifically FHA, conventional, and VA. Obviously, if you're paying cash, you don't have to have mortgage insurance, clearly, right? So let's start off with talking about FHA. Because what I've been telling people is if you're paying FHA, you're going to have it for the whole 30-year loan. But is that necessarily the case? Is there a way to pay it off sooner or get rid of it?
Yeah, so there's no way to pay it down to remove it on FHA. So essentially the minimum down is 3.5%. If you were to do 3.5%, you would finance in an upfront mortgage insurance premium. This could actually also be paid upfront too if you wanted to, but most people will finance it into their home loan. And that percentage is 1.75% of the loan amount, right? And then you would have a monthly premium. In addition to that, it's 0.85% again, and then that's amortized over the life of the loan, right? So you'll pay a monthly premium and an upfront. You can drop the monthly premium if you put more like 5% or more down. It drops down to 0.8, and then if you put 10% down, right, you can actually pay mortgage insurance up to 15 years. But I mean, essentially, that's the majority of the length of time people will actually own their house. The average ownership now is 10 years. So the likelihood that if you get an FHA loan that you will pay it for the duration is very high.
So if you're doing FHA, you're either going to have to put more down initially to pay less, or just pay what you give you, but you're not going to ever get rid of it unless you pay more down.
Yes. Now, there's a lot of benefits with an FHA loan, though, that I do just want to throw out there. Typically, they have lower interest rates than conventional financing, and they definitely have lower interest rates for people that have, mid to lower FICO scores. So it does make home loans more affordable. That's the actual whole idea behind FHA. So even though you do pay higher mortgage insurance, typically those monthly payments are actually more affordable than the conventional alternative.
And I want to say I'm guilty of that. I'm sorry if I ever gave the impression that FHA is bad because of its permanent mortgage insurance. A lot of times when my clients and I have ran numbers, if you're like a starter first-time home buyer, even with a lower mortgage insurance or higher mortgage insurance, the lower interest rate offsets it and makes a lower payment. But I also understand if it's a long-term house, sometimes people want to have a look forward to the idea of getting rid of it, right?
Well, and here's the idea, guys. You just want to compare loan programs, which is why, again, you just don't want to call up and say, this is what I want. You want somebody who can actually structure multiple scenarios to present to you.
So while we're still talking about FHA, is it also true that you're getting the same rate as everybody who's buying FHA at the moment? So
there are credit hits typically, but it isn't until you go lower on into the credit. So typically if you have a 620, 640 credit score and above, you do get the same interest rate as somebody with a 700 credit score. But here's the deal. If you were somebody with a high 700 credit score and you're putting 3% down,
might as well go conventional, right?
I mean, it depends, right?
Yeah.
It honestly depends on the situation, and you would want to compare that alternative, right? But if you're under 700, I mean, the conventional alternative will a lot of the time be more expensive.
Which conventional loans, what I've always told people is, with conventional, if you have a great portfolio, the scenario, your credit history, your job history is just a healthier loan. The mortgage officer or the lender can actually shop around your mortgage insurance for them and possibly get them a better number. Is that true or not true?
That is true.
Okay.
They're all very similar, but there are some that offer specials, or one will have a higher credit hit than another will. So it's always really important that they shop around. We definitely do. And then just one thing to note, there's multiple ways of constructing your mortgage insurance premiums on a conventional loan. So you can buy it out up front, right? That's always a really great option, especially if you have a higher credit score, right? Because
For conventional,
okay. Because oftentimes that will give you the lowest monthly payment. Then you have the option of splitting it, where you pay a portion up front and then you pay a monthly premium. You can do just a monthly premium.
That's huge, because most people think that you need to put 20% down to get rid of your mortgage insurance, which is true. But there's actually ways for you not to put 20%. You can actually buy out the mortgage insurance initially.
Totally. Right.
Okay.
So
with
conventional financing, the only caveat to that is that a lot of people will buy out their mortgage insurance and then they'll want to refinance and they don't quite have the equity. You'd have to pay that over again, or if you sold the property and under the recap period, you might end up paying more. So if this is like a
long-term house,
4+ year investment, I would definitely look at that. Again, you're going to want to talk to your loan officer about it. But the cool thing is there's a variety of different ways to construct your mortgage insurance payment.
So there is eventually a way to get rid of that mortgage insurance long-term.
Yes, there totally is. So one way is just doing a principal reduction payment, so paying the home loan down up until you get the 20% equity. Now at 20%, you will have to call most lenders to request that it gets removed. It doesn't automatically come off at 20%, which is a common misunderstanding.
Yeah, they think lender's not going to call you and say, hey, let's save you money.
And so it automatically drops off actually at 22% equity, which is 78% loan to value. Okay, so that's when it drops off. Now, if you have done, major improvements to the property and you've actually repaired the home and now it's worth, you have 25% equity, you can definitely call again and apply to have it removed before that time period. But most mortgage insurance companies will want a minimum of 2 to 5 years of payment, truthfully. So you'll want to look at what the terms of that policy is. And then also they'll want 25% equity if you're not paying it down. Yes, and one thing I will say about, because you just reminded me of that, about how they calculate your loan to value. So when you are doing principal reduction payments, it's going to be off of your purchase price, right? So that's what they're going to look for. If you are basing the value of your home on like the current market, right, that's in and of itself a completely different model. And again, that would be 25% equity versus 22 or 20.
How about VA? Anything different there?
Yeah, so VA doesn't have a monthly premium. They do have what's called a VA funding fee. So it goes into a pot of funds that guarantee all VA loans. You don't have to pay, the VA funding fee if you are a disabled veteran of more than 10%. Those premiums will vary depending on the military branch that you were in, and then also if you've had if you've taken it out more than once.
Is there any last notes or tidbits that might help people look out for maybe saving down their monthly payment with mortgage insurance that maybe you didn't talk about today?
My biggest thing that I can just emphasize is how important it is to get multiple scenarios presented to you with, because most people will think that getting the lowest interest rate will actually have the biggest impact on your payment. And so really, really talking to your loan officer about how they structure mortgage insurance will actually probably have a better out-of-pocket monthly expense for you.
If you're in the Phoenix real estate area and you're looking for a realtor and a lender, my contact information is below. For all my first-time home buyers out there, you guys know already, most of the time she's the one, her team take care of you guys and do a wonderful job. So for initially, reach out to me first so we can help you and get the situation. I'm sure she doesn't like if I say that, but if you watch my realtor or lender video, I always say talk to the realtor first, so it is what it is. You're my channel, Lizzy, my rules. No, I'm just kidding. All right, other than that, guys, thank you so much. I appreciate your time. If you have any comments or questions, please leave them below. Lizy and I will be looking through them. And if you have a really complicated question, then she will answer it for you. Thank you guys. Have a good one.